Have you ever wondered whether your index fund is really as passive as you think? Because following the record-breaking SpaceX IPO on June 12, 2026, there's a growing realization on Wall Street that millions of ordinary investors have been effectively drafted into buying one of the most expensive companies to ever hit the stock market. We're talking about SpaceX, a company that arrived on the public stage with a valuation pushing $2 trillion, despite reporting billions of dollars in annual losses. And if you're investing through popular index funds, you now own a piece of it, whether you wanted to or not. But here's where things get even more interesting. Leading up to this, some of the world's biggest index providers, the companies that decide what goes into the indexes behind your ETFs, had quietly changed their rules. Those changes allowed a massive IPO like SpaceX to enter certain indexes far sooner than companies of the past ever could. Supporters say that was simply keeping pace with today's market. Critics argue it essentially forced passive investors to buy into a highly valued company before it had enough time to prove itself on the public stage. So, are index fund investors being used as exit liquidity for early investors? Or is this just another example of the market evolving? Let's break it down. The myth of the market. Most people think that when they buy an index fund, they're simply buying the market. But that's not entirely true. You're actually buying a list of companies selected according to rules written by organizations known as index providers. Companies like S&P Dow Jones Indices, FTSE Russell, MSCI, and NASDAQ decide which businesses belong inside many of the world's most popular indexes. Those indexes then become the blueprint for trillions of dollars invested through ETFs and mutual funds. And every time money flows into one of those funds, a small portion of the fees ultimately goes back to the index provider. That creates an interesting balancing act. On one hand, investors expect index rules to be stable, predictable, and consistent. On the other, these providers are businesses competing with one another. They want their indexes to stay relevant, and that means they don't want to miss out when enormous companies finally decide to go public. SpaceX, the test case. That's exactly why the SpaceX IPO became such a fascinating real-time test case. For years, companies typically reach the public market after decades of growth. Today, that has changed. Private companies are staying private much longer, while raising enormous amounts of money from venture capital firms and private investors. By the time they finally list on a stock exchange, they can already be worth hundreds of billions or even trillions of dollars. SpaceX is perhaps the biggest example we've ever seen. The IPO became the largest in history, instantly making it one of America's biggest publicly traded companies. Naturally, investors want exposure. But the question isn't whether SpaceX belongs in the market. The question is how quickly index funds were required to buy it. The evolution of fast entry rules. Traditionally, newly public companies weren't added immediately. Many indexes required them to trade publicly for months before becoming eligible. That waiting period served an important purpose. It allowed the market time to discover what the company was actually worth. IPO prices can be extremely volatile, excitement fades, reality sets in, sometimes prices soar, sometimes they collapse. Waiting helped prevent passive investors from automatically buying at the most emotional point in a stock's life. But recently, that approach changed. NASDAQ introduced rules allowing certain very large IPOs to qualify for inclusion after only 15 trading days, rather than waiting roughly 3 months. FTSE Russell also adopted fast entry rules for qualifying mega-cap IPOs, which paved the way for SpaceX to enter several of its indexes within days instead of months. Not everyone agrees this is a good idea. Several U.S. state investment officials questioned whether these rule changes adequately protect passive investors, arguing that they deserve greater transparency about why the rules were changed in the first place. Now, before anyone panics, this doesn't mean every index rushed to include SpaceX immediately. One major provider took the opposite approach. The S&P 500 still requires companies to satisfy long-standing rules, including profitability requirements, minimum public float, and at least 1 year of public trading. As a result, SpaceX could not enter the S&P 500 immediately, even after its IPO. That distinction matters because much of the online discussion makes it sound as though every index provider has abandoned its standards. They haven't. Different indexes now have different approaches, and that's where things have become much more complicated. Why this matters to passive investors. So, why are investors paying so much attention to this single IPO? Because index funds don't make decisions the way individual investors do. If you're actively investing, you can look at a company's financials, decide it's overvalued, and simply avoid buying it. Index funds don't have that luxury. Their job is to follow an index as closely as possible. When an index provider adds a company, funds tracking that index are generally required to buy it. regardless of whether the timing looks attractive. That's why inclusion in a major index often creates enormous buying pressure. Imagine hundreds of billions of dollars managed by ETFs and pension funds, all needing to purchase the same stock within a short period. That demand alone can push prices even higher. For companies going public, that's incredibly valuable. For passive investors, it's more complicated. The concern isn't that SpaceX is necessarily a bad business. Few would argue against its achievements in reusable rockets or satellite communications. The concern is whether investors are paying too much for future expectations. History is full of companies that were expected to dominate entire industries but failed to justify their initial valuations. Others exceeded every expectation. The problem is that nobody knows which category a new IPO will fall into. The valuation debates supporters of a premium valuation point to SpaceX's unique position. The company has transformed the commercial launch industry, built the world's largest satellite internet network through Starlink, and continues to win major government and commercial contracts. Many investors also believe SpaceX has opportunities far beyond rocket launches, including satellite communications, defense technology, and deep space infrastructure. If those ambitions become reality, today's valuation could eventually look reasonable. But critics see things differently. They argue that markets often become overly optimistic during blockbuster IPOs. When expectations are already sky high, even strong business performance may not be enough to justify the price investors paid. That's why seasoned investors often prefer to wait. Instead of buying during the excitement surrounding an IPO, they let the market establish a more stable valuation over time. It's a strategy based on patience rather than prediction. Should index fund investors be worried? This isn't the first time index providers have faced a challenge like this. Over the years, several massive companies have entered public markets with enormous valuations, forcing index providers to decide whether to include them immediately or wait for the market to settle. There's no perfect answer. Include a company too early and passive investors could end up buying near the peak of an IPO frenzy. Wait too long, and those same investors might miss out on significant gains if the company continues to climb. It's a balancing act that has become increasingly difficult as private companies stay off public markets for longer. Decades ago, businesses often went public relatively early in their growth. Today, many of the world's most valuable companies spend years raising money privately before ever selling shares to the public. That means when they finally list, they're already giants. And giant companies are hard for index providers to ignore. Why are the rules changing? Some critics believe the recent rule changes primarily benefit large companies and their early investors. The argument is straightforward. If a company enters a major index shortly after its IPO, index funds tracking that benchmark must buy shares. That creates additional demand, which can support the stock price during one of the most important periods in its life as a public company. Supporters see it differently. They argue that an index should reflect today's market, not the market from 6 months ago. If a company instantly becomes one of the largest publicly traded businesses in the country, excluding it for an extended period could make the index less representative of the market it's supposed to track. Both sides have valid points, and that's exactly why this debate has become so controversial. How big is the actual risk? One important detail often gets overlooked. Even if SpaceX joins certain indexes quickly, it isn't going to dominate your portfolio overnight. Modern index methodologies don't simply use a company's headline valuation. Many also consider factors such as the percentage of shares actually available for public trading, known as the free float. If only a small portion of the company is publicly available, its weight in the index is usually reduced accordingly. In practical terms, that means a new mega-cap IPO might represent less than 1% of an index at first, not 10% or 20%. That's still meaningful, but it's far from the catastrophic scenario some headlines suggest. What should investors do? For long-term investors, the answer may be simpler than many people expect. If you invest in index funds because you believe in broad market exposure over decades, then short-term changes to index composition are part of the journey. Indexes evolve, companies enter, others leave. That's how they've always worked. On the other hand, if you're uncomfortable owning highly valued IPOs before they've established a track record as public companies, it's worth understanding exactly how your chosen index operates. Not all indexes follow the same methodology. Some are quicker to include new listings, others take a more cautious approach. Knowing those differences can help you choose investments that better match your own philosophy. Final thoughts. The real story here isn't just about SpaceX, it's about how investing is changing. As private companies become larger, stay private longer, and eventually go public at enormous valuations, Index providers are being forced to rethink rules that were written for a very different era. Some changes may prove beneficial, others may not. Only time will tell. For now, one thing is certain. If you're a passive investor, being passive doesn't mean you should stop paying attention. Understanding how your index is built, who decides what goes into it, and how those decisions affect your portfolio is becoming more important than ever, because in investing, it's not just the companies you own that matter. Sometimes it's the rules that decide when you own them. What do you think? Now that the IPO is behind us, should index providers have moved so quickly to include companies like SpaceX, or should they have waited until the excitement had settled? Let us know your thoughts in the comments below. If you enjoyed this breakdown and want more videos explaining the biggest stories shaping the financial markets, don't forget to like, subscribe, and turn on notifications so you never miss an update. Thanks for watching, and we'll see you in the next one.